Currently, interest rates are sitting at 7% with the expectation that they'll be somewhere around 6.34% by the end of 2025. In today's episode, we're going to talk about what the experts are saying. We're going to give our predictions on where we think interest rates are headed. And we're also going to talk about what generally moves mortgage rates altogether. So Josh, mortgage rates, the bane of our existence for the last 6 or so months. They go up, they go down, and create a lot of confusion. So
6 or so months, let's say the last two and a half years.
2.5 years.
Coming out of COVID, everyone expected the government's going to have to get the heck out of the mortgage market and rates are going to normalize. No one quite expected normalizing to include runs up to the 8% range, which we've seen happen twice now. We got a nice correction last holiday season, not 2-3 weeks ago, but a year ago. We saw rates move down into the low sixes, and we're like, okay, inflation's moderating. Fed's probably going to start cutting sometime first half of the year, and the market kind of got ahead of itself. We talked about that during Christmas season of 2023, that rates probably should not have come down this far, this fast, but they did. And then we got 3 months of hot inflation readings, hot jobs readings, and rates shot back up. And we got almost back up to 8% at one point in the late spring, early summer. And then again, we see a repeat of it. So kind of what I like to talk about or think of it in terms here, Jeb, is we had a really big shock with COVID, a big global thing that our federal government, the Federal Reserve, the Treasury reacted to by doing a lot of things, and we're getting echoes of it. Those echoes are getting less, but we still haven't seen them completely go away. And to a degree, we should probably expect that to continue through 2025 with more volatility than what we would normally expect.
So with that, Josh, let's talk about what generally moves mortgage rates, because I think there's a misnomer out there when it comes to what actually impacts mortgage rates. The idea that, hey, the Fed's meeting, that they're going to drop 25 basis points. It's in the news. Okay, all of a sudden, there's this expectation in the market that, hey, I'm not going to do anything now. I'm not going to lock my rate. I don't want to do anything. I want to hold off because somebody told me that the Fed's going to lower interest rates. Therefore, I want to wait. I want that lower rate, and couldn't be further from the truth. So let's set that expectation straight for one, and then kind of go through what is impacting rates, because volatility has been probably the biggest issue in the market overall. It's not so much the data, it's what the data creates in the market that causes this chaos, this confusion. And I think if people know what to look at, they have a better idea of what to gauge and what they should be doing on their side.
There's a couple things to think in terms of. Back in the late 80s, early 90s, there was this concept that came about of efficient market theory, saying that markets are efficient, and at any given point in time, they've assimilated all available information. So the price of any bond, the price of any stock, mutual fund, ETF, crypto, at any point in time, it's assimilated all the information. It's kind of been misproven because markets are forward-looking, and that's what we have to deal with. So we say, if you're sitting at home saying, hey, the Fed's going to cut on Wednesday, I don't want to lock on Monday, do you think you have some sort of special insight? No, the markets already know that. So people trading mortgage bonds, people trading treasuries, people doing anything out there are already forecasting and projecting and looking ahead. It doesn't mean they're right, but the price of any security on any given day tells you what the market is thinking is going to happen going forward. So we're going to kind of walk through all of the things that the market is looking at and anticipating and making judgments based off of. One of the things, Jeb, that you and I like to talk about a lot on the show, the futures market is projecting a 98% chance of a rate cut at the next Fed meeting. It's not. They're projecting a very low chance here at the January meeting. But when we say that, it's not guaranteed, but it's telling you what the market believes as of today. And as more information comes in, all of the things that we're going to talk about watching here, those beliefs are going to change. So we're at the beginning here of 2025. We're going to make a 2025 forecast. But guess what? That forecast is going to change almost immediately as more information and more data comes in. Sometimes it falls in line with what your expectations are, and you go, see, we were right. Most of the time, additional data comes in and goes, hey, this isn't quite playing out the way we thought it is, and it's going a different direction.
And one of those things that does impact rates, or at least the bond market in general, kind of overall, is the Fed, right? Not necessarily the Fed funds rate, but what the Fed says at a press conference, what the Fed says in their minutes, the quarterly minutes or what have you. And the reason for this is transparency, right? They're trying to kind of get ahead of the market and let the market know, hey, this is what we're thinking. And then that's how the market gauges expectations, and that's what they trade on. And that's why when you're expecting a 25 basis point cut and they come out and do it, there's no market reaction. But if there is no transparency, or if the opposite happens, hey, the market's expecting this and the opposite happens, that's where you get volatility in the market. And honestly, Josh, that's probably where we've seen the biggest chaotic movements, if you will, over the last year or year and a half, is these expectations that inflation is going to continue to moderate, which it has, but we can talk about it. Jobs are going to continue to climb higher. The jobs numbers are going to continue to climb higher. More people are unemployed. More people are filing for unemployment, that sort of thing. But we've seen the opposite, right? It's the market's expecting this, we're getting that, creating confusion, that lack of transparency, and that's what's causing these issues with mortgage rates. So let's kind of go over some of these things, Josh, in addition to jobs and inflation, what impacts rates, and help I guess the listener understand how each of these plays its own little part in the big picture.
Really, there's not a whole lot beyond inflation and jobs. Inflation, for you listening to this at home, you understand it. You know, hey, if I need to buy a car now, it's a ton more expensive than when I last did this 5 years ago. When I go to the grocery store, items there are much more expensive than they were 2 years ago. So we all know that. And we go, okay, inflation. So why does that matter? Someone investing their money, someone making a loan, lending it out, needs to get their money back plus a profit, plus enough to cover inflation. So when inflation is high, they require a bigger rate of return. So whether it's people lending their money to the government in the form of treasuries, whether it's people buying mortgage bonds and lending to you to buy a home through that mechanism, whether it's a Fannie Mae loan, Freddie Mac, FHA, VA, it's investor money. So when inflation is high, they want a higher rate of return so that they get a real return above and beyond what inflation ate away while you had their money. So inflation's always going to be the number one, because number two there, we look at the jobs and people go, well, jobs, why is this even an issue? Why are you talking about it? Well, we're talking about it because unemployment has been really, really low. Most people who are in a position in their life to be thinking about buying a home have a good career. They're good employees. They go to work. They make money. So for those type of employees, hasn't been a hard time finding a job. It's really been, hey, am I happy on my job? Am I getting a good raise, or do I switch to a different job? At some point, we will see an inflection, and we're not necessarily saying, hey, the Great Recession, I don't remember, it was 12 or 14% where we peaked on unemployment, but almost 10% higher than where we're at right now. So if we go from 4%, which is the range of where we are today, to 6%, now there's going to be people feeling it. There's going to be good employees out there that are not able to either find a job or find a job paying as much as what they're making today. So really, that will become a factor. And the way it has been a factor that you have not felt in a negative way over the last few years is when unemployment is really low, employers feel that. They have to pay more to get employees, whether it's government mandated in the forms of higher minimum wage, which as a home buyer, probably you're not making minimum wage, so that doesn't matter to you, but competitive. A competitor to your employer says, hey, we need someone, and Susie's really good at this. She's making 72 grand. I'll pay her 84. And then your employer goes, no, Susie's really important. Can't lose her. We'll pay you 90. You get an $18,000 pay raise. I don't know if that's common, but it's certainly things that we've seen and felt. So as you transition away from this really tight market where people are making more, which feeds into that inflation, to a looser labor market where people are happy to have a job, not switching, not moving around, not getting pay raises, not spending as much money, those are the mechanisms that are primarily going to lead to lower rates as we get to whatever the new normal is going to look like.
Now, we started the show by talking about the expectation. The expectation taken from an average of, I don't know the actual number here, Josh, 14 major research groups, is that interest rates will end 2025 by 6.34%. So the idea, if interest rates are 7%, that they're going to move lower. But there's really three ways that interest rates can move in 2025. And one is up, one is down, as we said, and one is kind of sideways. This is what we've seen probably over the last 6 months or so. We've seen it go up, we've seen it go down, we've kind of seen it bounce around, kind of ending back where we were in the spring part of the year. So before we talk about the idea of a 6.34% interest rate, Josh, let's talk about the opposite, higher rates. What could actually cause interest rates to move higher from this point? Now, both you and I have talked about, we didn't think interest rates would go back up to 8%. One of the guys that we follow, Logan, over at Housing Wire, we're at the high end of his range right now, 6.25%, or 7.25% rather. What could cause us at this point to move even higher in mortgage rates? And yeah, I mean, it's not a good thing either way, but yeah.
Well, we just talked about the two things that could happen but are unlikely to happen. Inflation seems to be moderating. If you look at the charts, the trend is in the right direction. So don't expect it to take a spike. Jobs market could get even tighter, could remain tight or get tighter. Those things could lead to higher interest rates. Last January, we got a really, really hot jobs report, which was highly unexpected, and that was sort of the run up through the spring, or started that run up through the spring in terms of interest rates. But the big wild card right now, we're going to have the second inauguration of Donald Trump here later in January. And markets are somewhat concerned about some of the plans, policies, the cost of extending tax cuts, the impact of tariffs, whether, it wouldn't be necessarily long-term inflation if you have an increase or placing one-time tariffs, but it certainly increases the costs and the downstream cost of any inputs that we have in terms of items that are imported. So that would be the wild card. If we get higher rates, it would be because the market reacts negatively, not just to policies proposed by the Trump administration, but policies actually enacted.
Right. And so I think it's important to note for anybody listening is that interest rates don't move one direction, and stay in that direction, right? It's not one of these movements where, interest rates decide to go down and all of a sudden that's the trend from that point forward. What we saw over the last year is interest rates started higher. Or actually started a little bit lower, rather. They moved higher into like April, May, at which point we kind of saw interest rates peak, and then they started to move down, and we thought we were out of it. We thought, hey, everything is starting to line up. The bond market got better. Everything just seemed to fall in line. And like you said, Josh, things moved a little bit too low too quickly, almost scary to our side, going, how are interest rates moving this fast without anything really data dependent coming out? And then we saw the opposite happen, right? The Fed came out, announced 50 basis point cut, which we thought, yeah, that's awesome. Actually, a little bit more than expected. And then rates shot up, and then they continue to move up throughout the end of the year. So Josh, before we talk about lower rates, what's advice on somebody looking at rates in this year, right? I mean, how do you gauge something that is so hard to gauge in direction and, and where it's headed?
Well, it's funny, coming off of 3 years, 2022, 2023, and 2024, that were volatile and unpredictable, we've now gotten to the point where when we look at forecasts, the forecasts this year are much less certain than what we've seen the last couple of years. So why? Why is that? Everyone's gun shy. And so you think that the near-term future is going to look like the near past. So volatility, unpredictability, which probably means we're going to have an unvolatile, predictable year this year. But actually, I don't think so. I think that comes a little further down the line. But when you see that, what the last few years have taught us is don't think you know what's coming next. I have probably 10 people that missed that window to refinance back in September because they were going to wait. Rates are going lower. The Fed's going to cut. Rates are going lower. The Fed's going to cut more. Rates are going lower. Failing to see that markets are forward looking and it already priced in all of that, and that things change as data comes in. So I think the big lesson for you as a first time buyer, as a move up buyer, someone selling your house, buying another home, is the decision should be driven by where you are in your life. I want and need and am financially ready and stable for a home. And find the right home and buy it at that time, regardless of where interest rates are going to be over the next 12 months. Now, that's not to say, hey, if rates go up to 8%, go ahead and do it. It might price you out of the market or price you out of what you want and need, and at which point you would have to regroup and step back. But look at Logan's number, a range of 5.75 to 7.25, which we're at 7, very near the high end of that 7.25. I agree with that. I think rates will trend down over the next year, but not in a linear manner. So if you hear that, a lot of people go, well, I'm going to wait. Our lease is up in March. We'll wait and we'll get into a new place in April or May, and we'll get a benefit from a lower interest rate. Maybe not. But Resi Club also went through, Lance over there aggregated 26 forecasts of different home analysts. And those economists believe that home prices are going to average, among all those 26 forecasts, 2.7% appreciation over the course of the next year. We see the vast majority of that appreciation between the start of the spring buying season, March, April, and the end of that summer back to school, July, August. Mm-hmm. So if we say 2% of that happens in that time frame, if you're in a neighborhood or an area where you're looking at a $400,000 home, you're probably going to see 2% appreciation by the time we get to the middle to the end of the summer. $8,000, $10,000. That, with mortgage rates in that 7% range, is $60, $65 more a month. So rates coming down a quarter, 3/8, probably 6 of one, half dozen of the other. So it's not to say that rates don't matter. Rates do matter. It's not to say marry the house, date the rate. It's to say we don't have certainty that we're going to get lower rates. If you have certainty that you want to buy a home, the most important thing is finding the right home for you that is going to serve you and your family for years to come so that you don't feel pressure to move sooner. Or, hey, we get this window again where rates drop down to 6% and now we're going out and taking whatever home is available just because we feel pressure that rates may not stay down at that level. So that would be the big takeaway for me. Volatile, unpredictable. We have a belief and expectation that rates will grind lower throughout the year, but in an unpredictable and volatile manner. So go when the time is right for you and get the right home. And what I would say as a mortgage person, I'm telling people don't rely on buy downs to get a 6.25% interest rate or a 6.5% interest rate because you like that payment, because that's money that otherwise, if we're using that same example, if you get 2 points from the seller, so $8,000 that you could buy that down, well, they also would have took $8,000 less for their home. So it's a sunk cost one way or the other, even if the seller or the builder, someone else is paying for it. So look at keeping your costs low. If you're buying when we're near that 7.25%, 7%, 6.75%, and if we get down to 5.75 and the seller wants to give you 2 points to buy it down to 5.25%, maybe you consider it when we're at the lower end of the range. But it sounds paradoxical. Well, when rates are towards the higher end is when you don't want to pay to buy that rate down because it's a sunk cost. When you get to the lower end, you think, hey, we may not have an opportunity to get lower here. You might want to consider it.
Yeah, and we strongly believe that it's never too early to start the pre-approval process. So if you're thinking of buying a home in 2025, regardless of what that time frame is, reach out to our team. We would love the opportunity to guide you through that process, answer your questions, and ultimately help you become a homeowner. And if we can do that, or if you would like to do that, rather, there's a link in the description of the video where you can get in touch with us, or you can go to theeducatedhomebuyer.com/expert and get in touch with us directly. So, Josh, we've talked about interest rates moving higher. We both believe that interest rates are going to move lower. So what do we need to see at this point with lower interest rates? Inflation is likely going to continue to come down, at least for the foreseeable future, right? We don't know the policies are going to be enacted here in the next couple of weeks, the first 100 days, what that's going to look like and what impact it's truly going to have. And in fact, even if we see policies here in the next 30 to 60 days, the impact is probably 4, 5, 6 months from now, if we're being honest. So what do we actually need to see in order to see mortgage rates get off this 7% handle and get somewhere in the 6% range?
If we look at the inflation piece of it, we've seen disinflation. So not deflation, not drops in prices, but much slower rates of inflation in almost all goods, and even some deflation in goods over the last year. Services is where we've seen the elevated rates of inflation, specifically insurance, homeowners insurance, auto insurance, medical, and on top of that, shelter. So we know that shelter inflation has moderated a lot, still high, but much lower than what has been captured in the data. And last month, CPI and PCE finally showed that moderation that we know has been happening on the street, but was going to show up in a lagged basis. So David Rosenberg, an analyst that I love following, the last report he did on December 31st shows their model is projecting that core PCE, the Fed's preferred measure of inflation, will be under 2% by the March reading. And I'm like, That's pretty aggressive, but that could lead to lower interest rates. If we see the job market slowing, we saw a bunch of bankruptcies and closings. My wife was very, very upset that Party City is going out of business, but a lot of fairly big national chains either going out of business or closing stores. Foot Locker closed stores. A number of those issues. So if we see unemployment continue to tick up, and we get to that 4.6, 4.7 in the high fours, you're going to start to see the market go, whoa, this economy isn't quite as strong as we think. You also may see when Trump gets into office, the art of the deal. He loves making deals. If he makes a deal with China and there's no tariffs, makes a new North America trade pact with Canada and Mexico and there's no tariffs, some of that fear pricing in there will come back out. So there are definitely some things that can move in our favor. I think a lot of what we saw post-election was the market pricing in what is the worst case scenario of what could happen with tariffs and other Trump policies. And when we see them actually play out over time, hopeful that they will moderate. So those are things that could lead to lower interest rates and more affordable housing for those of you looking to buy this year.
Yeah, and one thing that we saw last year, Josh, in addition to inflation coming down, jobs numbers getting a little bit worse, and what have you, is mortgage spreads improving, right? So we saw mortgage spreads improve considerably in 2024, which allowed interest rates to come down, even at a time when things weren't really going in the direction that we thought. So we could see further improvement in mortgage spreads, which could allow interest rates worst case to stay the same as the market gets worse, or in some cases maybe get better as the market continues to improve along with it. So I think that is something that we should watch for as well.
Well, the spreads were at their best levels of the year when rates were at their lowest levels. So as rates come down, the spreads should also continue to moderate for a number of reasons. When we see the spreads blow out is when rates get really high. So as long as we see this slow grind lower towards interest rates, we should see improvement in the spreads. And when we say spread, we mean the spread between the mortgage rate that you pay and where the 10-year treasury is at. We are at least 0.5% still above what is considered normal over the long haul. So even without the 10-year coming down, you could see 3/8 to 0.5% improvement in mortgage rates just with some normalization. Now, the reality is you're not likely to get one without the other, but you're likely to get both of them in conjunction if rates do come down.
So with that, Josh, we've talked about rates moving higher, lower. You mentioned that you think interest rates will move lower. We're not one to give big, bold forecasts here, but what are your thoughts on rates and expectations for the market in general?
I don't believe the economy is as strong as what a lot of people do believe. I don't think that Trump is crazy. I think in some degrees. Let's be careful. So he has a big ego and he wants credit. He wants things to go well. So you could say, well, that leads him to think that he's going to win all of these deals by actually imposing the tariffs. I think it's all a negotiation, and he doesn't want the economy to stumble too much on his watch. So there's likely to be sort of a Goldilocks year here. What does that mean for interest rates? We talk about when we closed several refinances for folks under 6%. And I thought that was too much, too fast. When we were, at almost 8%, and then within 90 to 120 days, all the way down at 6%, it's too much, too fast. But if you go back and listen to our forecast from last year, thought it was very realistic that we end the year under 6%. So I think that's reasonable for next year. I do think the market's gun shy. I think that it will move forward in fits and starts. But if you tell me that we get to the middle to the end of next year and we've got unemployment inching towards 5%, we've got inflation at or below 2%, depending on your preferred measure, and rates are at 5.75, 5.875, I don't think it's crazy. And, setting that range, I don't think 5.75 is your absolute best case. But I think in terms of a probabilistic range of saying with 90% certainty, that 5.75 to 7.25 that Logan has set is accurate. when I look at a 6.34 at the end of the year, I think that depends on, that is dependent. Rates being that high are dependent on a stronger economy than I see and feel. So let's also remember that if you're looking to buy a home, you want a strong economy. You want your job to be solid. You want pay increases coming. You want inflation under control. So there's this give and take and a balance. If we had just a stream of bad news leading to 4.99 rates by this time next year, there would be some collateral damage and you might not be feeling as positive about your situation.
Yeah, and I think it's important to note, guys, like if you want really low rates, you've got to be hoping for a, not a terrible economy, but well, low, it depends on how low you want them, but a much slower economy overall. So it has pros and cons, right? If you want lower rates, that might mean you might lose your job depending on what your employer looks like. Same thing, a much stronger economy, jobs numbers going lower, all of these positive things might mean interest rates move higher. But I'm in the camp of you, Josh. I think interest rates will move lower. I think it's going to look a lot like 2024 in the sense that I think we're going to see lower rates and this expectation that, hey, this is the new norm. We're going to start seeing them move lower, and then we're going to see some volatility and then move higher, and kind of this bounce back and forth that's hard to predict. And the reason is I just think it's taking longer than all of us expected to get the negative news out there in the economy that I think we all kind of have a feeling is out there. It's just not showing in the data for one reason or another, and it's delayed in some sense. And so some bounce back and forth. But I think interest rates, I definitely think in the mid sixes is probably going to be our average for the year, if I had to guess, which means half the year is probably above that number and half the year's below that number to some regard. So do we see a 5 handle? Hard to say. I thought last year we definitely did, and we saw it. It crept. We had it. It was gone.
Saw it for 2 days.
Yeah, and so it's. I don't want to set the expectation that, hey, if you wait, you're going to see lower rates. I don't think that's the case. I think if you're buying right now, buy with the expectation that that is your rate. And if and when you have an opportunity to refinance and take advantage of a lower rate, God bless you. Congratulations. As long as you qualify, you're in good shape. But I don't think you should be buying with, I can barely afford this now. When that 6% interest rate comes later this year, then I can refinance and it'll be affordable. Because if you do that, you're setting yourself up for failure. And we're here, we're always talking about, becoming the educated home buyer. The educated home buyer for us is somebody that's buying at the right time of their life. They've got some money in the bank. They're not using all of their money for their down payment. They've got some money set aside and they're making smart financial decisions overall.
Yeah, good credit, minimal debt. Those are the things that you should be working on. And when the time comes for you to buy, it should feel right. I would say, Jeb, the folks that we're closing loans for and have in the last 6 months on the purchase side, they're folks that like, hey, I don't like where interest rates are, but I'm going to keep my costs low on the way in. I'm going to hope for the ability to refinance lower, but we need a home. And now is the right time in our life, and we can afford this, even if this is the worst case scenario.
So with that, guys, let us know what you think. Where do you think interest rates are going in 2025? You can let us know in the comments. And if Josh and I can be of assistance to you, do us a favor and reach out using that link in the description of the video. But until next time, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.